In the market, we are hardwired to chase the ascent. We focus on green lines pushing higher and our portfolio values climbing in real time. Financial media and social platforms treat investing like a video game. They frame it as a pursuit of the highest possible score before a deadline. But giving back capital is a standard part of any market cycle. Volatility is the price of entry, and losing profits during a correction is a mathematical expectation. Even so, watching an account balance drop from its peak creates emotional friction. We mourn the money that was once on the screen, which often makes us lose sight of how the system actually works. Fixating on these short-term gains creates a blind spot. While we stare at the peaks, the foundation of the portfolio is often left unprotected. There is a massive distinction between losing a floating profit and losing your principal, the actual money you work to earn. A loss of profit is a setback, but a loss of principal is an exit. Without capital, you have no way to take a position, effectively removing you from the financial ecosystem. This reveals the underlying game theory of the market. Investing is an infinite game. Finite games are played to win within a fixed time frame. Infinite games have no finish line. The only objective is to continue participating for as long as possible. The primary job of an investor isn't to get rich quickly, it is to avoid being forced out of the game. Compounding is an exponential force. It starts slowly, appearing flat for years before the curve begins to steepen. Time is the primary fuel here. This vertical explosion only occurs during the final stages of the timeline. To experience this delayed growth, the investor has one requirement. They must stay solvent long enough for the curve to accelerate. Because these mathematical laws are so consistent, failure usually happens when human behavior breaks the process prematurely. Investors lose their principal when they fall into 4 specific behavioral traps. First is ego. This is the refusal to adapt when the market proves you wrong, driven by the belief you can outsmart the collective data. Second is leverage, using borrowed money to increase the size of a position. Leverage creates a dangerous imbalance. While it can scale your gains, a minor pullback in a leveraged account can wipe out your entire principal instantly. Third is overconfidence. This leads to concentrated bets, where a single mistake can dismantle the entire portfolio. Finally, there is denial. This is the act of holding a failing investment while capital evaporates, simply because you refuse to accept the reality of the loss. These 4 hazards don't just reduce your earnings, they destroy your ability to play the game at all. Achieving long-term success requires a change in how we define a great investor. Anyone can make money during a bull market. The mark of a professional is the ability to protect their starting capital when the environment turns hostile. The rule is absolute. Your first priority is the defense of your capital. The math of compounding only works for those who are still at the table to benefit from it. Focus on survival today, and the infinite game will take care of the rest.